What are the best index funds or ETFs to buy? That's a big question. It's one that we get asked all the time, and it's technically not one that we can answer. Not exactly anyway. But we can highlight the most popular types of funds there are, talk about why they're popular options, and show you how to find popular funds in each category. When looking at which index fund to invest into, there are lots of things that you need to consider. Like the ongoing charges you'll pay, how many businesses are being tracked and invested into, what parts of the world are covered, the volume that's being traded, and loads more. But we're going to simplify everything over the next 12 minutes. Nothing I say in this video is financial advice, all investments have risk, fund names and indexes are included for example purposes only and are not investment recommendations. We'll start by looking at one of the most popular fund categories that investors like to choose due to the amount of businesses these funds track and how many geographical locations are covered. And these are passively managed global index funds. The popularity of global index funds helps keep fees on the lower side because there's more demand, which in turn makes them even more popular. They have some respectable ongoing charges, with an average all-world fund costing between 0.1 and 0.3% in annual fees. As the name suggests, global funds will track businesses across the world, giving you exposure to a wide variety of countries and markets that diversifies your portfolio. This alone makes these types of funds appealing to investors, as you can spread your investment out across multiple assets, meaning you're not relying on one business or even one country to perform well in order for your investment to grow. So, say the UK suddenly went into economic crisis and the stock price of all the biggest businesses based there went down. Sure, this would still affect your investment, but seeing as the UK would only make up a percentage of your overall portfolio, it would be propped up by the other countries in the index, meaning that you wouldn't just lose your entire investment immediately. That said, global funds that are weighted by size are heavily skewed towards the US market because of how large the companies there are. But perhaps the most appealing thing about a passively managed global fund is the simple fact that they are passively managed, meaning that you don't have to seek out and invest into any of these companies for yourself, and you're not trusting anyone else to seek out investments for you either. The fund will simply follow an index that is tracking the biggest companies all across the world. If you want examples of popular global index funds that are available across a range of popular brokers, you can gain access to our free index fund cheat sheet in the description below. While spreading your investment out over multiple market sectors and countries is a strategy used by many investors, a lot of people like to be more specific with what they're putting their money into as well, with many choosing only to invest into companies with a high ESG rating. Global ESG funds are pretty similar to global index funds in the way that they track businesses across the entire world and spread your investment out, but the key difference here is that there are specific requirements the companies in the list must meet in order for them to be considered. ESG stands for Environmental Social Governance and is a rating system that tells you how ethical a business is in regards to the treatment of their employees, consideration of the environment, and other things like that. Some investors like to invest into funds that only track companies with high ESG ratings, and this is usually because of personal beliefs, but also companies can sometimes see their share prices fall due to social pressures around unethical business practices, so it can be a belief based on potential price movement too. However, in more recent years, the integrity of these ESG ratings has come into question due to the disparities from one rating system to the next. A business could get a high ESG rating from one source and a much lower one from another. Also, with the amount of greenwashing that goes on in today's world, you never really know whether a company actually cares or whether they're just telling you that they do it to look like a model employer. That being said, global ESG funds are still a popular choice, but now we're going to be looking at other categories that are much more popular with investors. Global ESG funds are part of an investing strategy that is growing in popularity, and this is where you choose investments based on a specific theme, also known as thematic investing. The idea with a thematic fund is that you're tapping into a market that is either growing or is one that you're very confident will grow in future, and this is why global technology-themed funds are so popular these days. It goes without saying that technology is one of the fastest growing and most lucrative market sectors you can invest into, with companies like Nvidia, Apple, and Microsoft, to name a few, being amongst the biggest businesses in the world. With global tech funds, you're still spreading your investment across multiple countries, but you're only tracking the biggest tech companies in each, meaning that if the technology sector continues to grow as it has been, your investment might benefit more as every business in your portfolio should grow with it. The downsides of global tech funds and thematic funds in general, and this also applies to ESG funds, is that because they're more niche, fees are often higher. You are also relying on whatever market sector or theme you target to perform well, otherwise, if it starts to decline rapidly, your entire investment goes down the drain. Also, there's always the argument that future growth is already factored into the current price, so future growth might not actually move the market that much, if at all. So even though it's always important to do your research before investing, it is crucial that you are very confident in the theme you choose before you put your money into a thematic fund, whether that's a technology-focused fund or something else. Another reason why thematic investing is popular is it gives you the chance to invest into some market sectors early before they grow in size, allowing investors to potentially benefit even more from growth should it happen. But this isn't the only way people are putting their money into markets based on future potential. Investing into emerging markets could potentially yield similar benefits to this, as you're putting your money into up-and-coming economies that could see sharp growth in future, and that's why funds in this category can be popular for investors. When investing into emerging markets, depending on which index the fund is tracking, you'll be gaining exposure to around 20 to 25 different smaller but emerging countries across the world, and some of the countries that are classed as emerging markets may shock you. For example, China is still considered to be an emerging market despite having a pretty huge economy that is still growing. Then you have other up-and-coming countries like India who have seen substantial growth over recent years. And just to give a few other examples, emerging markets include economies like Argentina, Brazil, and Saudi Arabia. With a fund that invests into emerging markets, you still get a diversified portfolio compared to focusing on a single stock, theme, or country. But along with that comes a few added risks like market volatility and fluctuations in local currencies. Also, there's an argument that the biggest economies are the biggest for a reason, and therefore they could be more likely to grow than more speculative bets like emerging nations. The next fund category is slightly different to the ones we've looked at so far, as they focus on the real estate market, but instead of buying property yourself and having to manage all of the headaches that come along with that, REITs or real estate investment trusts allow you to buy shares in properties like you would with a business. These funds can also have higher average dividend yields than other investments due to laws surrounding them. In the UK, REITs must distribute at least 90% of rental profits to shareholders each year, and in the US, REITs are required to distribute at least 90% of taxable income to shareholders each year to retain their REIT status. REITs also allow you to diversify your property investments, whether it be through investing into office buildings, apartments, shopping centres, or even investing into properties in other countries that you wouldn't have been able to before. Putting your money into a real estate investment trust fund also has the benefit of being far more liquid than buying physical properties, as it could take months to sell a house or apartment, whereas due to the high trading volumes of these funds, you can sell your investments almost immediately. So it's a lot more appealing for investors that don't have huge amounts of capital to be throwing around on luxury housing. And given how the housing market has risen exponentially in the last decade or so, it's easy to see why this type of fund might be so popular. One of the main reasons people choose REITs is for diversification, not just in the property sector, but to act as a potential hedge against inflation or stock market investments. Diversification seems to be an underlying theme with most of the categories we've talked about in this video, and the next type of funds are no different, offering what is generally regarded as a safer investment into short-term debts and corporate bonds. The total bond market is used by investors to gain access to thousands of different bonds across various sectors and maturities, which can help to reduce the risk as opposed to investing into individual bonds. Through investing into these types of funds, you'll generally lower the volatility of your investment while still seeing some steady returns. Although it's worth noting that returns are never guaranteed and that all investments will always have risk. If you're approaching retirement or want to keep your investments fairly liquid, then the total bond market offers a way for you to do that without just holding your money in a bank account to be eaten away at by inflation without the larger risks that are typically associated with the stock market. And that's why these funds are as popular as they are. Because they can help diversify your portfolio, they're relatively short term, and they're more liquid. You can also invest into these funds pretty easily and for a lower annual cost than, say, a global index fund, with the average ongoing management fee being around 0.03% to 0.15% per year. While these funds might not be seen as long-term investments by many stock market enthusiasts, they are a popular choice for people to store their money in until they either decide what they want to invest into next, or if they want a bit more protection on the value of their portfolio in exchange for a smaller upside based on past performance. Though past performance isn't a reliable indicator of future results. And last but not least, we have funds that invest into the S&P 500, which is an index of the 500 biggest businesses in the US. While the S&P 500 doesn't offer as much diversification as a global fund, it does include some of the biggest companies in the world like Apple, Microsoft, Nvidia, and Tesla, and covers multiple different market sectors, so your money is still spread out compared to investing in a single stock. Also, global index funds that are weighted based on company size have quite significant exposure to the S&P 500. S&P 500 funds are popular with investors due to their historical average returns and endorsements from some of the leading names in finance like Warren Buffett. These funds also tend to have high trading volumes, which leads to pretty low ongoing costs, and because there aren't thousands of businesses to track, this can help lower costs too, with many providers charging less than 0.1% a year for their S&P 500 funds. The historical growth, low fees, and big-name endorsements make S&P 500 funds appealing to not just the US investors, but all investors around the globe. As a reminder, you can find a range of popular S&P 500 funds across different brokers in our free index fund cheat sheet that's linked in the description below. Even though the fund categories we've covered are all popular with investors, that doesn't mean that they are guaranteed to work for you. So before you invest into anything, make sure you have researched heavily and know exactly where your money is going. There are lots of examples where indexes that look like they track the same businesses actually end up being vastly different when you scratch beneath the surface. To take the MSCI World Index and the FTSE All-World Index as one example, investing in either one of these could heavily affect your investment, and it's not exactly clear to see why. So let me explain in the video on screen now.